First of all, I'd like to thank Bill and Scotty for inviting us. Fortunately for me, this is a pleasure for me to meet back up with Rick. I've known Rick for 20 years. Worked with him on a number of engagements where he's helped the companies that I was working with at the time in numerous ways. I'd also, before I start, I would like get a sense of the crowd here in terms of how many first year, second year, joint degrees and so forth. So how many of you have had some exposure to the energy curriculum so far? Okay, that's good. How many joint MEMs, MBA types do we have? Okay, so if we get stumped on anything, then you're the ones who are going to have to answer the questions. What we'd like to do is try to circle around four basic questions. What is merchant generation? Just to make sure that we have the same terminology and that we present it in a way that hopefully you'll see some of the, while we end up with the other three questions. We want to talk a little bit about where we are today and what brought us here over the last 20 years in particular. We'd like to talk a little bit about, as leaders in this industry, what do the CEOs, when they think about the direction they're going and so forth, how do they deal with these issues? What kind of expertise do they lean on in their organization? That type of thing. And third is based on where we are today with all of the certainty in the future, we'll probably end up with a series of questions that we'll be expecting most of you in here to answer. I have to state clearly that the views that I give today are my views, not the views of EDF Trading or the EDF group out of Paris. Okay, very briefly, up until the early 1990s, all of the generation in the U.S. was that was investor-owned was regulated, and that grew out of 75, 80 years of what sprang from the birth of electricity in the U.S., where the monopolies of electric power distribution emerged, and so you saw everything was very region-specific, local-specific. You never had, there was no national roadmap put together back in the 30s that says this is how the U.S. energy infrastructure is going to develop. And so in a regulated structure, what you end up with is because of the monopoly power, is that you end up with regulators that set price on the price of the commodity that comes out of the generation. And it does it in a way that ensures a fair and reasonable return on assets and on equity. In many states, the actual commodity cost, the conversion of gas or coal or uranium or whatever, biomass, whatever, is the ups and downs of the commodity markets are passed through to the consumers. So the shareholders of those generations do not carry that risk. And so for that right to be a monopoly and to get a fair and reasonable return, there's very tight oversight of cost and revenue structure. In the late 90s, in the late 80s, things started to change, which I'll go through in a minute, which basically allowed for someone called a merchant generator to enter the sector. And this allowed generators to set prices at market price, not on a cost basis. It was driven by FERC and the Federal Energy Regulatory Commission and others to force this. But the bottom line difference between the two structures is for the person that's going to manage generation in a merchant environment, they have to understand the supply and demand fundamentals very well and understand the effect of that it is on price. Regulation is there only to make sure that market power is not exercised, so that there's no, and that's actually one of the biggest issues over the first 10 years was that things would pop out that had unintended consequences, which is, again, is a bit of a rule of thumb as markets undergo change, is even though you have good plans, things never turn out that way. And the other thing that was brought about, and that was one of the long-term aspirations when they opened up the power markets in the early 90s, was that this would bring about competition, would bring better, more customer-focused products, and would result in greater efficiencies across the U.S. as the markets evolved. And I apologize if I'm repeating some of this for you, but I think before we get into some of the evolution and why, I just want to make sure that we cover a few points. This is a kind of a recent map of the status of retail deregulation of power. The first thing that's kind of interesting about this is if you looked at this same chart from the EIA back in 1998, is the colors would not look the same. And at that point in time, California was open, Nevada was opening, Arizona was on the edge, New Mexico was, Oregon, even Washington State was considering things. North Carolina had some rules on the books in terms of tentative thoughts about changing the market. Georgia borrowed, a few pennies to think about maybe trying to open up the market down there as well. This market, the power market, is factually, it opened in roughly 1992, was about 6 or 7 years after the natural gas markets deregulated, which is a fundamental difference than Europe in that the power markets deregulated sooner than the gas markets. And that does have an effect on pricing.
What is suspended? Is that what it says?
Suspended, sorry. That means that they were heading down the path of deregulation and market pricing, moving the regulated assets out to be priced on a merchant basis. And primarily because of the issues with California around the year 2000, everybody said, whoa, wait a minute, we don't want to become California. And so they suspended all the regulations.
Suspended regulations or?
For retail.
They suspended deregulation. Right?
For retail,
right.
For retail, okay. Right. Okay, this is I think it's a relatively simple chart, mainly because I've seen it so much in the last 15 years. This is essentially a supply curve. And those that have looked at this, as you know, the way the power market works on a minute-by-minute basis. If you take demand, and if I say today, the bottom line, in case you can't see it, is the number of megawatts in a market on a per hour basis. If we said, okay, if the peak demand at this point is 40,000 megawatts, then the new combustion turbine at this time, based on the gas prices at that time, that would set the price for everything to the left. So that if you were a nuclear generator, a coal generator, what you get is a return, you get a contribution to capital that you can then use to save and hopefully use for investments, for longer term maintenance items, that type of thing. And this was, again, when you have relatively stable fuel prices, you tend to have relatively, on a snapshot basis, relatively stable power prices. However, it's never stable. And here's one of the reasons why. When you look at the map of where generation is in the U.S., and I'm not going to go through every little dot here, so rest assured. The light blue is where the predominance of natural gas generation is. The red is where it's predominantly coal. The yellow is nuclear, and the dark blue is hydropower. And what you see is Florida was heavily gas because it has no, with some nuclear. The Northeast was oil, and initially oil and gas with some hydro coming in from Canada. The Pacific Northwest, where you had a lot of public power up there, is primarily hydro. Actually, north of that is also predominantly hydro with British Columbia and some of the companies up there. And California was predominantly natural gas with some nuclear. as they tightened the environmental regulations down in California over 20 years. Now, why is this relevant? It's relevant because when you look at, this is the same supply curve I just showed you a minute ago, except this is with PJM, which is up in Pennsylvania, Jersey, and Maryland area, expanded, because that area reflects a lot of megawatt hours, about 160,000 megawatts. I'm not sure how many customers that represents in that PJM. But what you see here, this is, I'm just to show a little bit. Looking at the peak load, which is the orange is in the peak in 2010. The blue was the peak in 2009. The peak in 2008 was to the right of the one in orange. And so if you look down at the bottom line, what you see is a very flat supply curve. And so when you were in 2008, you had started to move up the steep part of the supply curve. This supply curve is priced every hour. And so what that leads to is a fair amount of dynamics. And this is actually comes from I borrowed this from one of the European utilities because I thought it was a pretty neat graph. On the left side, it shows short-term pricing, spot day-ahead pricing. And so what you see is the effects of the wind blowing, not blowing, where it strips demand away. You see the effects of a power plant trip. You see the effects of a cold snap for a few days or a hot streak for a few days. And this spot market or day-ahead price is very physical. At the same time, you've got people who own generation, merchant generation, are trying to figure out what is their revenue going to look like so that they can make investments in further improvements or dividends to shareholders or whatever it may be. And so they look at what's the implied forward price going to be. And that implied forward price is actually a market that is driven by lots of actors in that space. This is the physical power in this regard is if you, in the case of, because natural gas exhibits a similar type thing, because the thing that causes it to go up and down is not only the power, what makes the power price go up? It makes it, if you have volatility in the oil price, volatility in the gas price, all that makes it volatile. So you have lots of quantitative skills needed to understand the dynamics of a market, to understand the dynamics of the physical generation, the physical aspects of the pricing of the fuels. In the case of Europe, you have to factor in the cost of carbon and which units will be on the margin and so forth. As an example, where in the U.S. we really don't have a strong, we don't have, even with the voluntary markets and the RGGI market up in the Northeast, it's not a very meaningful market. In Europe, because this happened the week after I moved to Paris, the power markets, the German power markets for trading the next year was around 58 euros a megawatt hour. And the industrial customers of Germany can buy essentially close to wholesale pricing. Over the course of about 3 weeks, the price of German forward power for the following year went down by over 10 euros a megawatt hour. And so merchant generators who were able to sell at 58 euros 1 week, the next week, the best they could do would be able to sell at 48. Now, what caused that? What caused that was, it was right at the time when the governments of the various EU countries were coming out with how they were doing their allocations of their carbon credits. And all the researchers, the investment banks, the traders, they had views about where it would be. But there was a fairly big surprise that no one anticipated. And so what happened is carbon price went from 35 euros a ton to around 13 euros a ton in about a week and a half. And that movement of the carbon price is what moved the forward German power price by that much. And so again, as a risk manager and understanding the skills and and analytic requirements to understand the relationships between these various markets. These are the things that you know, have become 15 years ago. We're not even in the market today. Even in the U.S. market, you don't have that capability. You don't have that capacity in many of the utilities and merchant generators because it's not a big risk. But as we push, as certain people push for stronger carbon markets and so forth, these are things that they do play out. So now I'm going to turn it over to Rick and let him talk a little bit about the evolution, and then we'll start a little war stories.
There you go. Thanks, Jeff. And thank you for inviting me. This is great. You know, I've had a chance to meet a few of you and gauge the excitement. I think you should all be excited about what you have here. It's pretty tremendous, you know, and just this mixture of environment and energy and business. It's rare, and it's impressive. I guess before I start, how many of you saw the movie The Smartest Guys in the Room? Anyone see it? It's good. I'll talk a little bit about the enemy camp, right? The merchant generators, and I'll just put it right on the table. I work for some of the biggest coal generators in the U.S. I've been involved in board meetings, CEO meetings, so hopefully I can share to you a little bit of maybe what's going on the other side, if you will, or that side, as they're thinking through environmental issues, their response to environmental issues. And hopefully by the end you'll get a sense of at least the challenges they face as they're trying to make some of these decisions under uncertainty and some of their positions on environmental policies. But I think first, let's go back. Let's go back and try to build at least some of the context by talking about some of the eras that we've seen. Because this is why, you know, the smartest guys in the room take you through some of these, and you get a sense. But I think it's important to kind of go back.
And trust me, we're not the smartest guys in the room.
We're not, nor were they, apparently.
In this room.
Yeah. But you have to understand the merchant generators of today. You have to go back. You have to kind of go back to this first era where we call PURPA and competitive bidding. Now you had a completely closed utility system. Utilities were fully integrated, fully regulated, rate of return regulated. The first attempt by the regulators to try to get some sense of some market-based pricing was to say to the utilities, when you've got a new generation unit to go out and build, we're not going to let you build it. We're going to force you to go out and at least put it up for bid for contracts. And that created a big gas boom in the U.S. of these PPAs, this purchase power agreement, to go, you know, negotiate a 20-year contract to buy power from a third party. It's actually how Enron built the buy side of the gas business when they got started, those long-dated gas contracts. And it got a lot of new players into the game building power plants. The other thing we figured out you could do is, with a fixed power contract with a very credit-worthy entity, a utility, you could put a lot of leverage on that contract. You could probably put 70%, 80%, 90% leverage. So we began financing power plants with very, very high levels of leverage. And we started to see that through about '98. That was the time Jeff mentioned. About that time, we decided there was a major crisis in the Midwest where there was a shortage of power, and there was a general sense that with more competition, we could at least, the generation at least was a market that would work with competition. I don't think anyone felt that distribution could, right? That's a regulated monopoly, that's the best way to do it. But a lot of these states started to really play with deregulation. About that same time, we were very short of capacity, and prices were extremely volatile. Think about, you know, if you hear about California in the 2000, 2001 period, I mean, prices were just outrageous. But so we started to go through this deregulation. At the same time, prices were screaming and very volatile. You had all the big players, Enron, Dynegy, Mirant, really jumping into the game. And the merchant generation, it was a game of trying to produce EBITDA for the street. And Calpine would have this presentation where they would say megawatts equals EPS. But there was this mad rush to build gas plants. And we tried, for many of our clients, tried to stop it because we said, you don't understand, if you put all these gas units into this market, I'll come back to the supply curve, you're going to flatten out the middle of that supply curve, and none of you are going to make any money. But we got run over by many bulldozers in that process. And at one point, if you looked at it, between Mirant, Duke, and Calpine, just those three companies had 3/4 of all of the turbines that GE was going to produce in the world lined up for the next 2 years. That's how serious a run at gas had been created and how the froth had just gotten out of control. Now, the problem was we were starting to sell power into merchant markets, which were extremely volatile. Of course, we used the same leverage structure that we'd used in the previous market, 70% leverage. 70% leverage, unbelievably volatile markets. You're trying to build a gas plant, you don't even have a contract on it, you're trying to sell into daily markets. Not the most prudent of business decisions. And these trading models that were occurring then, you hear a lot about it. But to me, the best example was one of the clients I worked with was Mirant. They had made, $300, $400 million trading power in 1999. In 2000, that number grew to $1 billion. And they asked us the question, well, how sustainable is that? So we got underneath it and really looked at it. Turns out 70% of that number was coming from their West Coast desk on 10 business days. Where prices had just completely blown out and they had the right position. So now you're building a company with 70% leverage, where that income stream is supporting a lot of that debt, and you're dependent on 10 business days of trading. And other things that you would see in that time frame, these combustion turbines and these combined cycles, they made 90% of the money that they were going to make in a year in 10% of the hours of the year when prices really spiked. So anything that changed those spiky prices, whether it's regulation to cap them, or gas prices coming down, or new capacity coming in, creates all this volatility, and the cap structure didn't adjust. The rest is kind of history, right? And Jeff?
Yeah, I was going to ask just a little history question here for the environmentalist here. Why do you think that everybody went to gas beginning in the early 90s?
The Gulf War? The Persian War? The war in the Persian Gulf.
Clean Air Act?
The acid mining program?
That was one of the big items. There were probably three big items. One was the Clean Air Act being enacted in 1990. Mm-hmm. Second was there was
someone here had something to do with that, I suspect.
So there was lots of talk in Washington at the time about deregulating the wholesale generation market. They didn't know when that was going to happen. And all they did know is that they would have to put these plants out for auction and so forth. And a natural gas plant cost, pick a number, $300 million to build, $400 million. A coal plant cost $1.5 billion. If you had shareholder money and you weren't sure what the returns were going to be, where would you go? And third is there was a realization that they didn't think that there was a gas bubble, that there was going to be enough natural gas. There have been some big finds and so forth in terms of drilling technology.
Yeah. No, it was interesting. And Enron cratered. Credit became a major issue. It took Dynegy and Mirant and all the high leverage folks kind of down with them. And we spent months trying to figure out how to repiece, put together these companies, downsize them, sell off pieces. And then from 2003 to 2008, for the companies that were left, it was pretty ugly at the beginning. I mean, you were surviving day to day. You were trying to figure out how not to go bankrupt or deciding to go into bankruptcy so when you came out you'd be a better player, and Mirant went in and NRG went in. But then for those that were left, that had kind of gotten through that, at the tail end, gas prices took off again. And all of a sudden, they were printing money. And the street was saying, well, we don't want you hedged, we want you open. Because if you're open, that means that there might be more upside. And it was almost like people had forgotten what had just happened. And you know, the street would say probably completely opposite things within 18 months. And that took you through about 2008, and then recession happened. Industrial demand off 15%. Gas prices with all the shale gas, you know, cratered from $10. Now it's trading at $3.90. And the shale gas came in the Northeast too. So not only did you get the effect of gas prices going down, but now it's gas in market area. So basis differentials, what it takes to move gas from Houston to, say, the Northeast used to be $1. Now it's 30 cents. You know, so you just, it's a double whammy. And then, of course, the credit crisis. So these guys are completely levered. And
yeah, and in the middle of that, because of what they were seeing in the oil markets and the natural gas markets, the LNG market took off. And so because of what you saw in 2006, 2007, early 2008 with the gas prices, you know, they had, I forget the number of permit applications in Washington looking to build LNG regas facilities. The Qataris in the Middle East were just slapped full of adding trains to their reserves to, you know, generate the LNG.
So many people paid for regas capacity in the U.S. to basically take LNG and then convert it when it arrived here, paid a fortune for that capacity, and now it's virtually worthless. But a lot of swings, a lot of volatility. I don't know, Jeff, you want to comment? We've touched on some of these, but you want to comment on the...
Sure. There was a couple other things that kind of behind the scenes, when you didn't look at the facts were kind of, this is how the four kind of phases occurred over 20 years. But what's kind of behind that is also after the first Gulf War, the cost of capital came down, so people were much freer with you know, rolling the dice a bit on the cash. And as the markets looked like they were, because of the internet boom starting to pick up and everything, that they felt that they could, you know, the one who got their assets in the ground the first would be the winner. And so you saw, as Rick pointed out, Duke, Mirant, and others racing to get, you know, build generation, lock up the turbines. That was kind of the mantra for a while. There was a, you know, as the equity analysts started looking at the stocks of the utilities versus the hybrid utilities that were part unregulated and the merchant generators. You had the utilities that were trading at a PE of about 10. You had the hybrids that were trading at a PE of 17, 18. And then you had people like Calpine that were pure merchants that were trading in Mirant that were 25. And then Enron was at 29, shot up to 42 when they discovered the magic of broadband, only to drop off quickly. And there was another thing that kind of happened during this period, and it's really happened as a result of the crash of Enron. When we first started, with the company I used to work with, Louis Dreyfus, when we were the one who did the first power trade in the U.S. At that point, when we visited with utilities all over the U.S., you could not find a credit department in any utility. They had no need for it. They actually had it built into their rate base that so much % of their receivables would be uncollectible, and the rest of the utility customers covered it so that the utility would, you know, be covered. With the opening of the markets, with that merchant risk sitting out there, extending credit became a much bigger deal. But it wasn't apparent to many people. I mean, we had a system to be able to manage that. Enron did as well. There were few people that had the abilities to capture and do what's called mark-to-market accounting to understand the movements in forward price and what it places in terms of your financial potential future financial obligations. So Enron collapsed. Dynegy tried to save them. That couldn't happen. And then the initial merchant generation credit crunch hit. And so you saw many big players, Merritt, the Williams Company that had done 25-year deals, all of a sudden they realized that, oh my gosh, 40% of my sales went to Enron. They're not going to pay me. And then what did their investors say? Oh my gosh, you're not going to be able to pay me. You know, and so what you saw is just lined up people selling off assets as quick as they could. And there were not many traditional strategic players that were ready to step in at that point. And so what you saw was venture capital, more private equity moving into the space to say, look, the power business has become, the generation business has become an industrial business. It's a cyclical business that's going to be, if indeed the markets continue like they are, you'll go through overbuilds, underbuilds, overbuilds, underbuilds. And because of all the anxiety of everybody wanting to be first, there was an overbuild. And so you saw a lot of bottom fishers come in, and they bought assets at good prices in 2002, 2004 kind of time frame. So the new money comes in. The thing is about that new money is most private equity invest with a horizon of 5 to 7 years, not 30 or 50 years. And so they were waiting for that cycle to come back. And the cycle, you know, for some, when those who got in early, it didn't come back soon enough. And so they were ready to get out, and they sold out at the 2007, 2008. They were able to do okay. Others said, no, it's going to continue. And then you started seeing the effects of Bear Stearns. And Bear Stearns, it was interesting because Bear Stearns, when it had its troubles in, I think it was February of 2008, when JP Morgan bought them, about a year earlier had stepped in to help Calpine, because Calpine was about to go bankrupt at the time. And they created a new company called CalBear. Okay, so JP Morgan steps in to take out Bear Stearns. CalBear becomes part of JP Morgan's commodity business. And it was just what's going to happen, what's going to happen. So we enter the presidential elections of 2008. A lot of debate about cap and trade, all this other kind of stuff. And so people start to think, this may happen. It may happen. And what's that going to do to all these merchant generators that have coal plants? I'm buying power from Rick for 10 years, and he's totally fueled by by coal. Not now, but.
And I bought my power plants on my Visa card.
Yeah, and he bought his power plants on his Visa card. So how's he? I'm getting nervous, and that's what happens. So in the credit world, I get comfortable that, okay, I know Rick's good for probably $100 million from me, but if the markets really decrease, not increase, but decrease, it may not be $100 million that he owes me. It may be, $500 million, and I can't accept that. But that's the whole game of extending credit. And so after Bear Stearns and then the ripple effect down through Lehman Brothers, credit dried up. And so when it dried up, that meant everybody had to post cash. And those that were able to, those that didn't end up in litigation with their credit arrangements and so forth. Again, new money comes in because some had to get out. And I think that's kind of the nature of cyclical businesses, is that certain actors realized that they were better in a different business model. During this same period, more from probably 2005-ish through 2000, even today, you see some of the utilities that were wanting to be Enron-like, and then they wanted to be more like Calpine-like, now have become much more like regulated utility. Even some that were high proponents of deregulation are now asking for regulation back. So that's kind of the cycle that we've seen. And again, gas fundamentals are still there right now that, as Rick would tell you every day when he gets his morning gas report, if you think of that supply curve, it doesn't look like it looks like it's dead from your perspective. So, you know, again, that's just the nature of how things are moving.
So maybe a long-winded way to lay the groundwork, but when you think about how merchant generation CEOs are thinking about the world, I mean, they're coming from, you know, an industry that's at least as cyclical as the paper industry or just any commodity industry. But the inputs, gas versus coal, are not as correlated as some of these other industries. Plus, it's an industry that probably should be leveraged 30%. And in some of these, because of the history, they're leveraged 70%. So the volatility they face can basically put them out of business. And we've done lots and lots of work on, you know, is it more strategic to put this business in bankruptcy or to try to fight our way through it? And we continue to do that kind of work. So when you see the reactions to environmental policies, like carbon legislation, you know, for them it's survival. And you know, the Waxman-Markey bill, which many of these merchant generators supported because it had a 50% credit allocation to them, they thought, while painful, it was at least survival. And it was certainty, some certainty. And right now they face so much uncertainty that it's tough to do business. You've probably all seen this, and this is just a graph that I grabbed from one of my clients. But just, you know, to give you a sense, this just shows price trends. You'll see Synergy and PJM West Hub. Those are two liquid power markets. PJM West is probably more liquid. Oil prices, coal prices, and gas prices. Obviously, it's bounced all over the place. And you can see, you know, a couple things. I know it's hard to see, but if you look at oil, the red, versus gas, the blue, reasonably correlated, at least. Gas blew out in the 2005 time frame when oil didn't. But now oil's taken off, and because of shale gas, our natural gas prices are staying pretty flat. The other thing that's happened is coal's drifting up, right? There's so much demand for coal from China and the developing world. That's putting a lot of pressure on our coal prices. So if I'm a coal-based generator selling into a market, and we'll come back to the supply curve that's got gas on the margin, I'm getting pinched. And you can sort of see that with the power prices staying flat and more related to natural gas than coal. So that's my first problem. One is just the volatility. Gas prices at $10 versus gas prices at $4, and what that can do to my EBITDA. I'll show you that in a second.
And with one little point here with gas price, if you think of gas price, and gas can be anything from LNG to pipeline gas in the U.S. While you see that number for gas today, gas in the UK is twice that. Gas is roughly 3 times that in Japan. Now, if you're a LNG provider, where you're going to ship your gas, you've got a lot of empty regas facilities here.
Anyways, if you think about gas prices and you look at it, you go back to, say, 2007, gas prices are at $10. Forward prices are kind of holding in at 8, right? Today, gas prices are more at $4, and forward prices are not that contango. They're a little bit, you know, maybe $5 2-3 years out, but it's not moving. There's so much shale gas, right? You know, the weather in the Northeast, well, you've got hit with some snow, but the weather in the Northeast a couple of weeks ago, you know, probably the coldest it's been in a while, snow everywhere. Gas inventories at their lowest level everywhere, and the price didn't move. You know, and it's painful, and it's painful for these merchant generators. And there's a lot of volatility. Believe me, there's a lot of angst every day where I am. The other issue is capacity. So if I'm a merchant generator, I'm going to capture money from the difference between power prices and my generation costs. I'm also going to get some money for capacity. And I know the Internoc people were here a while ago. Well, they are partly responsible for this graph. because this is this coming graph. Because what for a merchant generator, you know, you want tight reserve margins. You know, this is capacity. This is capacity over peak demand. Over time, markets will tighten. There'll be a need for new capacity. As that market tightens, you're going to make more money as prices tighten up and you move out on the supply curve. If there's too much entry, it's going to push these reserve margins down. I'm going to make less money. So what happens around capacity markets matters a lot. And as a merchant generator, I've got to pick up a lot of money in those. And there's market mechanisms for those. In the Pennsylvania, Jersey, Maryland interchange, you bid ahead. You bid ahead 3 years to put capacity into the market, and you bid at prices that you're willing to accept. And then that market clears. And it's probably 30, 40% of the value of a plant that you have. So this is a complicated chart, but this is, it's RPM is the pricing mechanism in the PJM auction, and base residual is just, it's the name on this auction. But a lot of lines on this chart, I'd ask you to focus on the blue. So this is the RTO that my client works in. And if you look at the 2010 number, it says $174 per megawatt day. That's the way capacity is priced. So if I go back 3 years, people were bidding in the market for capacity that was going to be in 2010. That market cleared at $174 a megawatt day. That helped me. A couple of years later, as we had the recession, industrial demand went down 15%, our reserve margins fattened. Internoc and others came and they collected all of these demand side options, 7,000, 8,000 megawatts of demand side options, and bid them into the pool as well. Further depressed reserve margins in essence. Capacity prices fell to $16 a megawatt day, 1/10. So now I've got 30, 40%, what I thought was 30, 40% of the value of the plant, and I've just, you know, taken a haircut on, you know, 90% of that value. My debt holders are starting to get kind of nervous. And that's, you know, that's just all this volatility that these merchants face in prices, in capacity. Throw on top of it, well, geez, we're not quite sure there's going to be carbon legislation, and we're not quite sure what the prices are. And there might be command and control legislation that actually forces you to shut down some of your small coal plants. But there's some backroom discussions that suggest maybe I can cut a deal if I keep them running and close them down and get something for it in negotiations with the government in a couple of years. I mean, this is the swirl of things that are going on as they try to think about what to do. And then just as Jeff pointed out, you know, we've talked about it, but the credit implications are incredible, right? And this is just the merchant generators, and it's kind of hard to see, but if you look at that line, that's the ratio of positive to negative rating outlooks. And, you know, on top of it all, you know, there's a real impact on credit, right? I'm highly leveraged. I've got all this volatility. Prices are declining, so now I've got a lot of pressure on my debt. At the same time, the rating agencies have gotten burned twice now, right? They got burned right after Enron. You guys weren't paying attention. How could you miss this stuff? What's the matter with you? What's their reaction? Tighten up, lots of rules, new credit, et cetera, right? New credit requirements. 2008, credit crisis again, right? Same issue. What's wrong with you guys, right? How could you miss this stuff? So then the credit requirements get tightened again. So now I've got...
Yeah, and a lot of this ended up being where you had a number of companies had credit triggers in their credit arrangements, which I'm assuming the MBA students in here will understand those and be able to put those together in the future. But effectively what happened is as they get downgraded, there was an immediate demand on cash, and cash just got stripped out of the companies. And this is, you know, it almost became a death spiral in many respects for some of these companies.
Mm-hmm. And Jeff's had familiarity with one of them in the U.S. side that he probably can't talk about, but his EDF joint venture and partial ownership of Constellation, which was one of the companies that had a few credit issues, shall we say, in the 2008 timeframe. So let's talk a little bit. We've talked briefly about it, but let's turn to kind of, if I'm a merchant generation CEO, kind of what's on my mind? What matters to me? First of all, I guess just who are these guys? And let's just talk about this quickly. Probably names that you might recognize, some names that you don't, but they've all had a bit of a storied past. Calpine, in terms of megawatts, is the largest merchant generator. Actually, the chief commercial officer is a guy that worked with me quite closely at BCG. He says, this is the worst industry in the world, but the most fun. And I think that probably characterizes it. Exelon, big nuclear generators, and all those nuclear plants are merchant for them. NRG, a company that took itself into bankruptcy, emerged without a lot of debt, and has been kind of steadily rebuilding its position. GenOn, you might not recognize, that's Mirant, and then Reliant. Mirant went through bankruptcy. Reliant had to carve lots of pieces off of it to avoid bankruptcy, but they exist. First Energy in Allegheny, who I work with, is right up there. NextEra is the old FP&L. Big portion of that's renewable, but they're also pretty active. So these are the leading players. You know, you probably heard a lot of the noise around Dynegy. Dynegy was going to be bought by a private equity consortium, and then they bailed out at the last minute. And then Icon, who's on the board, has now got a new consortium that's buying them. We looked at Dynegy. At the trough in 2008, their stock price was so low that I was working with another generator. We could go in and buy them, take out the corporate center part of Dynegy, and it was equal to 70% of the value that it was trading at, just by eliminating the corporate center. That's how low these valuations had gotten. Duke has a very small merchant business, really only in Ohio, and even that is kind of a hybrid classification. It's not per.
So if you go back and look in the 2003 timeframe, at that point Duke was one of the they were going to be one of the winners of the first movers, and they invested heavily in California. And in 2003, I believe, was the year that they wrote off $3 billion. They sold their purchase contracts to a bank for $700 million, and then the CEO was replaced. So that's what happened to their deregulated business. They may still have some RIC in South America, but I think they're, and then the Ohio stuff that was made merchant for them.
A couple of issues that you hear a lot, and I'll just list them and I'll talk about a few of them. One is, well, I got these coal plants, and I've got a mixture of coal plants, both very efficient supercriticals and some small old ones that are probably unscrubbed. How do I get these things through this transition to a new carbon world? If I'm a merchant generation CEO, how do I do that? I'll talk about that in a second. Secondly, you know, I've got to grow this business. In some cases, I'm viewed as the earnings growth engine for the company. I've got to grow it, but the same token, there's all this risk around it. Now, how do I manage this risk and try to keep my debt holders happy? That's a big issue. And that's really the third issue. But then, you know, I'd like to actually re-access the capital markets, and I would like to start growing again when I can actually buy some more units. I wouldn't mind having more gas plants. Some of these guys were building renewables portfolios that they had to stop on. So there's just a question of regaining enough financial stability to then try to grow again. And then one of the issues that we wrestle with on the bottom, which I find fascinating, is, you know, my client, First Energy, sells into the market in multiple ways. We'll sell in the wholesale market. We'll try to bid on default service, where we'll sign a contract with a load-serving entity who will provide the default service. We'll go directly to large industrial customers. We'll aggregate governments, and then we'll go directly to the home. And to try to optimize those channels really creates some interesting dynamics, especially when you can introduce more risk by creating shopping in the market for some of these other products. So you actually try to introduce risk to advantage yourself. But let me just talk about a couple of these, and then we'll close with some comments from Jeff. First one is managing these coal plants. So this is a disguised but very real picture of one of the merchant generators. And what this does is it looks on a dollars per kW basis, the value of each of their coal plants as they see it today, looking forward. And the good news is that at least on the right-hand side of the page, a lot of my larger new units are actually worth still a lot of money.
Each one of these bars a plant?
Each one of these bars is a plant.
And
Width is the capacity, and the height is the value of that unit on a dollars per kW basis. Okay, so it's standardized for the value of the size of that plant. But you look at this picture and, you know, well, one, if I would have looked at that picture in 2008, nothing is in the red, right? And the right-hand side is twice as high, at least. And the right-hand side is totally a function of the spread between power prices in this market driven by natural gas and my coal price and my coal-based generation.
The assumption is that we will have a lot of natural gas, basically.
Well,
But the price will be low on natural gas.
right now, because the price, you know, the forward price for gas stays the same, that bar is probably at that height. A couple of years ago, if forward prices were 2x that, I mean, it was almost a direct ratio. That bar's higher, and there's nothing on the left-hand side. But these small coal plants are a big point of contention, right, with the environmentalists, because everyone would like to see them closed. I'll tell you a secret. These guys wouldn't mind having them closed either if they could get the right deal for them. But what they become is a bit of a bargaining chip, right? If I think I can get some sort of deal on these coal plants in some sort of carbon legislation, and there's been talk of, you know, incentive CO2 credits that would be paid in cash immediately, how can I close those units now and go to my shareholders and say, well, I went ahead and closed them anyways. You know, and 2 years later, some major deal comes out for CO2 legislation. So the uncertainty around environmental legislation is actually one of the things that's keeping these units running. I think people are going to be forced to shut them down, right? Now they've taken all these whacks, right? Gas prices are driving them down. I showed you the capacity markets. These units depend on capacity prices even more because they don't run that much. So as a proportion of value, these units have a lot more that's tied up in capacity.
Can I ask you a question?
Sure.
Relevant to this? So EPA is getting ready, it's nothing to do with climate, it's getting ready to promulgate, or at least trying to promulgate, a number of regulations on mercury and a variety of other things. And one, if one's so inclined, can read a lot of editorials in places like the Wall Street Journal that say this is going to be really terrible, and actually are documents from the power companies, from the power industry, saying this is going to be really terrible because it's going to force us to close those plants. So you're saying they're being a little disingenuous.
Well, I think no, and this is, by the way, this is after all the EPAC expenditures. Right. So this is assuming that you got to scrub everything, SNCRs like so. If all those regulations occur, this is a real picture. So they would have to close these plants. What some of them are, I think, genuinely worried about is what they would call the train wreck scenario. And the train wreck scenario is, it was a little bit more of a risk before the recession. But the train wreck scenario is, okay, we're counting on demand reduction. We're counting on wind. No one's really building gas plants right now. If we shut these small coal plants without any warning because of a response to environmental policy, we're going to be very short. And we're going to be very short, and the first time your friend presses the button at Internoc, you know, and the large industrial customers are off for 3 weeks in the summer, they say, we're not going to sign up for this next year. And there's just not, the gas capacity is not advanced enough in the queue to respond, and we're short for a while. We're kind of back to 1998. It may be a little self-serving, but I think there are a number of folks in the industry that say that, look at that and say, and if that happens, there's going to be so much re-regulation, it'll be just a mess when we're all done with it. That's at least the argument.
Kind of on that point, I'm wondering with the capital markets so tight and talking with merchant generation and other, you're looking at coal plants that are kind of coming to the end of life, a lot of nuclear that's coming towards the end of life. With the market so tight and looking at 20, 30 years for a payback on a large plant, like, what are the projections for our baseload capacity in an unregulated market where we're trying to find 5 to 7 year return intervals, and that's not really feasible for baseload generation, at least my understanding of it.
Well, I think the question is who owns it. If it's a strategic, if it's going to own it for 50 years and that's their core business, they're not looking for the 7-year return. The problem is that when you look at, as a business, stability and understanding the playing field is that much more important because just the magnitude of the risk are so much higher because the amount of money is so much higher. So that's why you look at things like in the UK where they're looking at trying to impose what the fossil generators call a carbon tax, to basically provide a floor to the price of carbon so that it provides enough economics to be able to fund new nuclear over there.
But it's a good question, and I think you could even extend it to say, does merchant generation, and we'll talk about, does merchant generation even have a future? Because how do you build new baseload plant in this market?
And right now the baseload units in many cases are combined cycle gas plants.
Right. Now this, and I'll get to your question in a second, this at least says, at least on 2 of these markets, the prices are currently high enough to justify new builds. You need about $115 a megawatt day, probably a little bit more with prices, say $150 a megawatt day, to support a new combined cycle if you make decent, okay spark spreads, right? A profit on energy prices. Some of the eastern markets are very tight and they currently support that. Of course, you can't get a permit to build there. There's New Jersey and the like, the eastern New York state. But what's going to happen is these are going to have to be stable enough price signals for people to commit capital to them. And right now, I mean, how could you go to your banker and say, I'm banking on this, when things can move as much as they did?
This is away from electricity, but I'm sure you've thought about this a lot. I hate to see natural gas being used for anything other than peaking. It's a terrific fuel and so much more versatile than a lot of other fuels. And do you have any feel of, given the tremendous differential in terms of embodied energy between oil and natural gas, that in the next 20 years there will be options that are going to close that up, which of course is going to have a big impact if you're building base load gas plants?
Well, it's almost like the genie's out of the bottle a bit. That's the only thing the U.S. has been building for 20 years is natural gas. And I forget the exact number, it's 20-some percent is natural gas.
But they won't protect you from the price. I mean, all the taxis in Argentina run on natural gas. There's possibilities for gas to liquid technologies. Fuel cells on. I'm just curious as to whether you're dismissing this or not.
I'd answer. Well, I actually answer a different one. I agree with you. I mean, natural gas is the right fuel for peaking, and combustion turbines. We need more combustion turbines in these markets in the future. And then the question is, what do you add baseload? And if we have more CTs, combustion turbines, we can add more wind. We can add more nuclear, right? We can kind of work on that left-hand side of the supply curve with lower carbon technologies. And if you're simultaneously building the CTs, the system can respond.
Or you make progress in energy storage and other things to help deal with some of that.
But we always kind of force the discussion back to wind, or just to wind, People kind of compare a wind unit versus other baseload. Now you can't do that. Wind plus a CT versus other baseload, now you can do it. And that's a fair comparison. But that's really, I think you need to think about adding on both ends of it.
Where does energy storage come in?
I don't know if you ever getting there. I mean, compressed air storage is getting there, certainly.
The question is scale. See, the problem is you've got, if you look at most of the coal-fired generation was built in the 40s, 50s, 60s, and maybe into the 70s a bit. That stuff's all, 50, 60, 70 years old. It's not going to last forever. And so you've got to replace it with something. And the question, right now, because of the uncertainty of revenue recovery, gas is the cheapest option where they have to build, and then again, the nature of who are the investors. Again, in the Southeast, it's a bit, well, in the Southeast, it's still not that different from the late 1980s in terms of the infrastructure, because you don't have, while wholesale-wise it's open, at the retail level it's not. Texas is completely deregulated. It's, there are wind generators in Texas that were not able to get long-term PPAs to finance those plants. And so every day they sell their wind generation into the market, which is very rare for wind, because the economics to invest in those things are usually driven off of a 10 or a 20-year PPA so that the financing can be done.
Well, there's hours where the price is negative in a market because the
turning down plants and
because they want to keep some of the thermal plants running so they can peak back up. But part of the problem on storage, it goes back to natural gas prices and how tight these markets are. If gas prices are low and the markets aren't tight, you don't have enough of a differential between peak and off-peak prices to justify the.
Yeah, and some of this you have to, as you point out, there's two examples that I found very interesting. One is there was an article this week that said that the fertilizer manufacturers are now reopening facilities in the U.S. when the gas, because natural gas is a primary component of making fertilizer. In the 2003, 2004 time frame, they all went offshore, down into the Caribbean and other places. Now they're coming back because shale gas and so forth. If you look at the investor presentation for NRG, which is a revived merchant company, one of their primary thrusts is they believe that natural gas is going to be the transportation fuel. And so they got one of their whole line of businesses is to integrate wind with CTs as well as be a fuel source for the new automotive sector. It's, again, it's different ways of thinking that, different people are playing it out. But that baseload component is, the industry hasn't really progressed significantly in terms of the cost, getting the cost down.
Considering regulation aside, what do you see as the most economical source for new baseload capacity? So, no real significant regulatory barriers. What do you think will be built?
Well, if there were no regulatory barriers, it's coal, period. No, end of story.
So after coal, would you say, I guess, nuclear versus natural gas, what would you say?
Natural gas at today's forwards is the most cost effective. But natural gas at 2008 forwards, nuclear is right in there. From what we've seen.
No regulatory, you mean without having to do any scrubbing or anything?
Yeah, with no carbon legislation and so forth.
Sulfur or anything?
Sulfur, yeah, no, exactly.
Like, and it's like the permitting process at in our Nuclear Regulatory Commission, that was not an issue.
Yeah, if you looked at just the the cost per BTU, coal is, coal is there.
And it's actually not the permitting process at the NRG.
Really?
I mean, it's really the regulatory recovery process in the states,
right.
And it's really the financing issues.
Right.
Right. I mean,
Regulatory recovery process.
well, I'm gonna go build. Well, first of all, if I wanted to try to build a nuclear merchant facility, which was talked about in Texas. So I'm going to go out and spend $7 billion. Who am I going to sell that to? How can I negotiate power contracts that are attached to that then I can go to the bankers and say, you know, I can leverage that 50%. That's tough. Or in a state regulatory environment, you've got to pre-negotiate, which Georgia has.
In North Carolina, you'll see that probably at least weekly for the next year and a half, 2 years. There'll be some discussion in the business press about what's called AFUDC or CWIP, about whether or not the regulators are going to allow the Progress, Duke, SCANA, FP&L, Progress in Florida, to recover before you're putting shovels in the ground, to basically reduce the cost of financing.
Well, some would argue, and I haven't been close to it, but some would argue the reason for the Duke Progress merger is to strengthen Progress's balance sheet and Duke's collective balance sheet to be able to support the nuclear build. Whenever we would do analysis, I think the nuclear build costs were 40% of Progress's total capitalization. Right? That don't work, right? It's just not going to work. So
it's an expensive business, but again, my parent company has the biggest nuclear operator in the world, and most of this was driven by the '74 oil embargo and the risk of not having natural resources. And nuclear gave them the energy independence that they've been able to maintain and now leverage up to their building plants in China and other places.
I have a question about what you see as phase 5.
Well, that's the next subject. But jump in. Let's do it now.
All of the people, the majority of the folks you see will be in the work field 2 years from now. So would you be short merchant gen or long?
I think there's a legitimate question as to whether the model continues to work in the future. I think there's a lot of pressure in even the deregulating states to re-regulate. I spent a lot of time in Ohio, and Ohio's kind of a hybrid. It's half regulated, half unregulated. And there's a big argument going on in American Electric Power's case right now about that very subject. I think in order for merchant generation to survive, we're going to have to figure out a way to add more stability to these capacity markets, for one. And we're going to have to come up with some environmental transition plan that will keep these companies afloat. I would argue that the benefit of sending price signals into the market every day and forcing people to compete is a benefit that we should aspire to as a country. And I would like to see it supported. But I'll tell you, if with all of the kind of administrative overlays and uncertainty, a couple things go wrong and this whole business barely survives. And then you go to re-regulation, but you can't do re-regulation part way. I mean, you can't have competitive choice anymore. So that goes out the wayside, and you're back to the world where the utilities are fully integrated. They go to the regulators and they ask for money, and they try to get a rate of return. And now this is probably being unfair, but I don't know if you saw recent events in Duke's history where the number 2 guy at Duke resigned because of viewed improprieties into negotiating basically with the Indiana regulators. But that's the way that game works, right? And it's not his fault. That's the way that game works. I think as a society, we've just got to decide. Yeah.
I think there's two longer-term issues that the U.S. has to deal with. One is it's hard for it to be, I think, competitive globally as long as it has the level of fragmentation that it has today in terms of ownership of different generation, central generation. Secondly is I think that without a strong national energy policy, it's going to take a long time to change because you've got at least 48 lower states that have their own views of the world. And until that model changes a bit, I think I mean, the good news is that creates lots of opportunities for everybody in here. The bad news is it's not going to be a, tick the box and the world's going to look significantly different tomorrow. There are a lot of dynamics in the business over the last 10 years in particular. 15 years. Since deregulation started, utilities started seeing lots and lots and lots of cost pressure. And so what you've seen is consolidations, mergers that occurred to basically strip cost out. You've seen early out programs getting rid of experienced people. And so what you see is if indeed you see a movement toward, some of these uncertainties get addressed and the economy then starts to react, where is the workforce that's going to do it? And it's going to take people with skills that understand business, environment, energy, and it's all its perspectives, and so I think it's a great field to be in.
Yeah, and there's a lot of change in ownership, so the private equity guys, they're getting back in, and there's, I think, a lot of opportunities with them to think through asset values and their portfolio and then managing the risk once they have it. Europe doesn't have these problems. They have different problems.
They have different problems. It was already consolidated. I mean, the number of players are much smaller. But, again, government subsidies and programs and policy, the effects are no different than here. In Germany, they gave strong subsidies for wind, solar. You had a tremendous build of wind in Germany. But the wind is all in the north of Germany. The south of Germany is where the old generation was. And so what happens if the wind doesn't show up? What does that do to grid stability? What does that do to the Swiss sitting up on top of the mountains controlling the hydro lever, waiting for the market to price so then they can dump the water in and capture that value and come in below the Germans or the French or other people? Spanish, they gave subsidies to build the solar and the wind industry.
Which almost bankrupted the company.
Country. The country.
It's unbelievable.
Because of the subsidy. So, again, it's different. And that's the thing the only advice that I could give anyone in here, which is if you want to be in the energy business, you need to be flexible, because for a business that sounds like it's the old, iron in the ground kind of business, it's a very dynamic business.
Yeah.
I'd just say that we've got about 3 minutes left, I think, in fairness to our speakers. So
Sure.
Either you're welcome to continue fielding a question or two, or if you have some final remarks you want to make for the record, you can do that.
Okay, well, that's helpful. Let me just address that, maybe personalize it a little bit. One, I think there's opportunities, but at least for me personally, I always had interest in geopolitics, had interest in energy. Part of me wanted to be an investment banker, but I didn't want to live that life. And I don't think you can find an industry that blends all of those disciplines. The risk management that we're involved in from day to day is pretty sophisticated with real stuff, and you feel like you're in the middle of any Wall Street commodity trading organization. Same time, you've got all the local politics and the politics of state regulation and environmental, and that's interesting. And then the finance side is wild. And you don't have too many markets where you have this much data and where the supply curves actually work predictively, minute by minute. And at least for someone that likes all that, this is kind of a good place to be. I hope these companies are there for you in the future, or that you can be around them, because it's pretty stimulating, I find. Jeff, you're...
Yep. No, just the only thing, again, thanks for inviting us, and we enjoyed it.